In this video, I'm going to review the concept of different life insurance policies, why consumers buy life insurance and why they don't, along with where do they receive their information. I'm going to go into the definitions and ideal clients for term, whole life, index universal life, and final expense policies. But before I start, I'm going to talk about most people think life insurance is just about getting a quote. And that's actually one of the biggest mistakes that one can make, because life insurance isn't about price first. It's about putting you in the right position. And that's why I like to have a holistic conversation to get to know the client so that they are placed in that right product. So some life insurance statistics here. Some top reasons why consumers buy life insurance. Well, to cover burial expenses and final expense. Sometimes it's there for the transfer of wealth or to leave an inheritance. If you think about it, you're passing away and your income is no longer going to be there to support the rest of the family. Or they go ahead and get life insurance because an employer will provide it to them at a very low cost efficient price. That is often a much lower death benefit, and it expires when you leave that employer at times. Some reasons why consumers don't buy life insurance, well, is simply it's just too expensive, or they think I have other, financial obligations that I could be putting that money towards, at that moment. And they're not sure how much I need to buy or what type of insurance is going to be best suited for me. It's kind of an, out of sight, out of mind situation there. So when we talk about life insurance, we're not just talking about a policy, but we're talking about protecting income. We're talking about protecting the family and creating that financial stability. And that looks different for everyone. Where do they do their research? Well, typically it's Facebook or YouTube. Sometimes they have an investment financial advisor that they speak to, or they often just hear it from their family, friends, or neighbors, and they want to know a little bit more about what they have, and they go ahead and contact an agent like myself. So where most people go wrong is shopping for life insurance is not. They shop for life insurance the way that they shop for everything else, based on price. They just want that quote, but quote alone doesn't tell you exactly what they need. Again, I can't stress enough the holistic conversation that we need to have. So yeah, just getting a quote can be dangerous because it doesn't tell you the goals, how it's structured, or even if it's going to be the right policy. It just tells you that number. So without a number without a strategy usually leads to mistakes. So first up is term life insurance, and that is going to provide temporary protection for a specific period of time. And that time period is typically 10, 20, or 30 years. Typically, it expires after the term ends. The beneficiary will not receive that death benefit or any money if they outlive the policy. If you still need that life insurance, you may be able to renew it, convert it to a permanent at a higher premium, or simply you could just go ahead and buy a permanent policy or another policy. There is an annual renewable term where premiums are no longer level, but a continuation, may be offered. And term insurance simply pays out a chosen death benefit. Now, at the time of application, you could go ahead and choose some optional riders, which is going to be an accidental death rider, a waiver of premium, a return of premium, a child rider, or you could access living benefits. And at the end of this, I'm going to review, what the details are of those optional riders. Now, who's going to be the ideal candidate? Well, for young families, it's great because it's very cost effective. It's a great choice for temporary coverage, and it covers the years that your family is going to rely on you. So, and it's also lower coverage for later. It's simple and affordable protection, no moving parts. It's income replacement, death obligations. It's there to pay for the mortgage, the loans, any other miscellaneous bills that you may have, and also it's there to pay for a legacy because your income is no longer, and oftentimes with a legacy you're going to replace that income for X amount of years going forward. It's very easy to understand. It's you make 3 decisions. What is my coverage amount? What is the duration? And what insurer am I going to go with? So whole life insurance. Whole life insurance is a permanent life insurance policy. It's going to be there for at the time of application until you do pass away, as long as the premiums are going to be paid. And it's also going to build cash value over time. This is often offered by mutual companies, and the big one is going to be Mutual of Omaha. Policy holders effectively own the company. There are going to be no shareholders in a company like Mutual of Omaha or any other type of mutual company. As far as the premium allocation, where's that money going towards? It pays fixed premiums, and it's going to be allocated between the death benefit, the insurer's operating costs, and the cash value contribution. So you have a monthly premium that you're paying. Let's say it's $100. And that $100 is going to be divided up into three ways. That $100 is going to be paying for a death benefit, operating cost, and it's going to be there for the cash value. That cash value, it is often billed tax deferred earnings. It works with a low risk investment, often used for retirement, education, or just simply emergencies. And it grows slowly over time, but it is guaranteed. It's very predictable. And you can withdraw partial cash surrenders. You could surrender the policy for cash, or you could simply use that cash value to pay for those premiums. Who are the ideal clients? Well, someone who's going to be seeking long-term protection, and then they could afford higher premiums. Higher premiums than a term, because term ends, so that's going to be cheaper. This is going to be here for the moment that you get approved to the moment that you do pass away, as long as those premiums are going to be paid. Conservative consumers, they like the value guaranteed rates. The cash value typically equals premiums paid after 10 years. And a little pause here, because going into something like a whole life, universal life, or index universal life policy that's permanent, that builds that cash value, you're not really going to see the money that you put in that cash value. It's going to equal it until about 10 years down the road. So you have to think about, I'm in this for more of the long haul. And you have to understand the reasons why you're purchasing this, hence why we need to have a holistic conversation. So this is also going to prioritize safety due to those guarantees. Parents like to buy these policies because it ensures the children's financial well-being, education funds, such as college, and also for trust building. Other adults purchase whole life policies because it covers financial obligations, funeral cost, final expense, and is often used to supplement Social Security. It's great for estate planning focus, where it's going to help loved ones cover those estate taxes, again, for those tax-free withdrawals. It's going to facilitate asset management and address other death-related expenses from an unexpected death. Now, universal life policies is also one of those permanent life insurance policies, and it's great for estate planning, asset transfers. It guarantees that death benefit and passes those assets to the beneficiary or fund's trusts. It's cost-effective, permanent coverage. It's the cheapest permanent insurance on a guaranteed basis. It has flexible premiums. You could increase what you pay or you can decrease what you pay, but you have to be very careful about that, because if you decrease what you're paying, then where are they getting that money to pay the premium? It's going to be coming from that cash value that you have grown over time, but it is a nice option when you do need it. It also has a flexible death benefit where you could adjust the coverage as your life changes, and you might have different needs for more or less of a death benefit. And it has the potential for that cash value growth because it accumulates that cash value over time. So again, estate planning and asset transfers, cost-effective permanent coverage, flexible premiums, flexible death benefit, potential for that cash value growth, and you have to have a good understanding of what you're getting yourself into when you get a whole life, a universal life, or an index universal life. But it has many, many upsides, but is not as cheap as a term insurance. Now, one of my favorites is an index universal life plan. This is also a permanent plan, and it works like a whole life plan. It's very cost efficient because you participate in the upside market potentials, and it's a guaranteed death benefit. That cash value is tied to an index strategy like the S&P, and it has a floor of 0. So let me explain. The floor of 0 meaning that we just talked about you can participate in that cash value growth in positive market upside years, and if that year comes with a downside to that year, well, you're not going to participate with that. So you will not lose your cash value growth. Index strategies can have a participation cap, a participation rate, and a spread or a combination of both. So, for example, if the S&P 500 does a period where you're getting 15% over that year, your cap may be at 10.5%. So your cash value will grow 10.5%, and the difference is going to be kept by the insurance company. The cash value can be used for premiums without decreasing that death benefit as well. So it's going to be there for that safety net for that cash value growth. And it's often used for tax-free retirement income through tax-free policy loans. The IRS is not going to know about this because this is not viewed as an investment, because this cash value growth is tied to a life insurance chassis. So who are the ideal clients? Well, high income and net focused earners who have, let's say they can't participate in a Roth IRA because they make too much money. And a Roth IRA, the benefits of that is, the tax-free benefits. But this is one of the only things that you could put your money into. And when you take that money out, it's going to be used, it's going to grow, and it's going to be used for tax-free purposes. High income earners who've maxed out their 401ks, like we just talked about, and they have the ability to contribute more. This is a great way to kind of diversify your portfolio. High income professionals that are seeking those tax-free retirement that offers that credit protection. And you have to be in the mindset of the investment of 30 to the age of 60. Not to say that you can't purchase it for a child, which I think is a great idea because it will grow tax-free. The death benefit may be a little bit lower over time, and then through that cash value growth, it's going to grow, hand in hand. As that cash value growth grows, the beneficiary, whoever is going to be on that policy, will also receive more than the cash value growth. This is often paired with a term policy. The term policy is great to be paired with this because of a few different reasons. One of them being, let's say that you're 30 years old and you want $1 million policy. You purchase an index universal life policy, but it starts off at $250,000. I told you that it will grow over time, but you want $1 million policy. So you can buy an additional term policy, before it gets to that $1 million. So you start off with $250,000, you purchase a $750,000, and you have a death benefit of $1 million. And over time, the IOL will increase up to the amount that you would like, and that term policy will simply just expire. This can also be viewed as a 401k alternative as well because of those tax-free retirement benefits. Now, a final expense plan. This is a whole life policy that pays medical bills, funeral expenses when you die. This is a permanent policy from when you purchase it, as long as the premiums are paid, to when you do pass away. There's no medical exam. It's simplified, or it's going to be guaranteed issue. So it's going to be very quick in the approval process. And the final expense is also going to be the most expensive type of life insurance. Typically, the death benefit is going to be up to $25,000, and in some cases, it can be up to $50,000. The uses for this death benefit are going to be funeral arrangements, embalming, caskets, flowers, and services, burial costs, including cremation, a burial plot, a headstone, and interment, and it's going to be there to pay for any outstanding medical bills or credit card bills. The ideal clients for a final expense policy is someone who's going to be closer to the retirement age, 65 to 68. I have even discussed this with, someone who's around the age of 55 because of health reasons. They don't qualify for life insurance, so they go ahead and buy a final expense plan. It's there for individuals dealing with health conditions that make that underwriting very difficult, and those who formerly had life insurance through an employer, now retired, and no longer have it. So a client who wants to just simply leave something behind because it's a much lower amount, but that $25,000 amount is going to be there for the burial costs and, again, any other remaining bills that they do leave behind. Most of these clients are going to be in the lower income bracket. And here are some of the most common optional riders. We have the waiver premium. Now these can be typically attached to any of these life insurance policies that I discussed. But the waiver premium is going to cover payments if you become disabled, for 6 months or greater. You have an option to have a child term rider where it pays out a death benefit if a child does pass away. So you go ahead and you buy let's say a term policy, you put on a child rider. You may have a $500,000 policy on yourself, but the child rider will allow about a $5,000 benefit for that child or children. It does have an option for an accelerated death benefit where you can access that death benefit early if diagnosed with a terminal illness. You could add on a return of premium rider where it refunds the portion of the premiums if you outlive that term benefit. And there's an accidental death rider as well, and that doubles the death benefit for any type of accidental death occurrence. And then the living benefits or a critical illness rider where it pays out a lump sum for specific diagnosed conditions. So this was your basic understanding of life insurance, the definitions, who the ideal client was, and in the upcoming videos I'm going to break it down more in specific and give examples of how these policies work and perform.